course, even as markets continue to be on turbo mode, here's what the most optimistic estimate on the street is looking like. And that's one coming from Karvy. It believes that the Sensex could actually reach 1 lakh by 2020. Let's welcome on board then Varun Goel of Karvy, who's joining in on the show. Varun, many thanks for taking time out for us. The Sensex at 1 lakh in 2020. What's really the hypothesis that you folks are working with?
So let me just first of all take you through what it will really take us to deliver that kind of number. What we are saying is that we are going to see a 25% kind of a compounding year on year in Sensex, which will take us to that 1 lakh number by 2020. In itself, it's not. We believe it's not such an aggressive number. We have seen earnings growth of 25% CAGR, in Sensex companies between 2003 and 2008 at 25%. So it has been done historically in India. It has been done historically in the United States and other parts of the world. So we believe it is very much doable. What we are seeing in India is a cyclical upturn from a very, very low growth rate of around 4.5–5% for last 8 quarters now. And we believe that gradually we are going to see a revival of the investment cycle. So the kicker of how the growth will revive. So if you look at agriculture, it's probably going to be muted this year. A consumption story has already slowed down. So what is really going to be a driver of the economy, we believe, is the upturn in the investment cycle. Now if you look at the capital formation activity, it has been quite muted for last several years, but we believe that as a lot of bottlenecks and structural issues get sorted out by the new government, we are going to see a strong revival in investment demand, and that is really going to be the start of a new earnings cycle. Of course, as new infrastructure gets created, that is going to have trickle down effects in terms of employment generation, productivity growth, that will lead to salary hikes and generally a sense of well-being and good consumption. So that is all linked, but I think the start would be with the investment cycle.
Varun, how much time in your view will it take for earnings momentum to get back to, say, 20+ level, which we saw a couple of years back?
Right, so now let's just look at how the numbers have been between the last 2–3 years. So we had FY13 earnings growth at 5%. We had FY14 earnings growth closer to 10%. And our own sense is that next year earnings growth should be at least 15%. Now, why I say that? We believe that we would have a nominal real GDP growth of around 6%. Add inflation of around 7% to it, we will have a nominal GDP growth of around 13%. In a time when nominal GDP growth is around 13%, I think earnings growth of around 15% is very likely. So I think the start of this cycle would see next year and probably a year after that would see somewhere between 15 to 20% kind of earnings growth, and post which, once the effect of the investment cycle really starting on catches on, then we are going to see a big revival in earnings. If I were to look back at the years of 2006, 7, 8, we saw earnings growth of 30–35% also, and I think those kind of times can easily come back as the economic growth goes to 7.5, even 8% by 2017–18. So that is really what we believe can potentially happen once the structural bottlenecks that the Indian economy is facing start to get addressed.
Varun, how do you really see domestic versus foreign flows pan out from here on? Because up till now, of course, the participation of flows is very important from institutional side. Up till now, it has been foreigners who have been dominating as far as Indian equities are concerned.
Yeah, so I think there are two parts to the flows question. First is the domestic. If you look at the mutual fund industry, the insurance industry, and even the HNI investors, last several years they've been almost out of the market. We've actually seen redemptions in most of these domestic institutional investors. We see that cycle reversing going forward. I think we're going to see a lot more of equity interest building in as this bull market continues. Also, I think the important point is that we are seeing a gradual shift from physical savings to financial savings. I think the real problem with India was that a lot of people moved from physical savings to real savings, which is real estate or gold, because there was very high inflation, and the only way to beat inflation in the last 4–5 years was to move into hard assets. I think now people are going to move money out of those hard assets and move into financial savings like equities, and that is really going to start a virtuous cycle of higher savings, higher consumption, which again leads to a higher growth. As far as the foreign investor flow is concerned, I think India is in kind of a sweet spot. If you look at the BRICS space, Russia is facing a war-like situation in Ukraine. China is going through its own slowdown. Turkey is having its own internal security problem. Indonesia has not seen the best of governments coming into place. Brazil, of course, is undergoing a period of very, very slow growth. So if you look at most of the large emerging markets, countries which can absorb large amount of inflows, India is relatively in a much, much better place. So we see, I know, the foreign inflows also continuing for the next few quarters.
You know, you guys have also said that earnings growth, you believe, is seen at something like 20% for the next 5 years. Keeping that in mind, which sectors do you suppose will lead the recovery, you know, when it comes to earnings over the next 2 years or so?
Well, I think if you compare the performance of public sector versus private sector in the last 10 years, between 2004 and 2013, public sector has been a huge underperformer. That is, I think, essentially because of the fact there was a lot of governance problems, interference, there was a subsidy problem. I think a lot of those sectors should see the first rebound. So let's take the example of oil and gas companies. I think we're going to soon have a scenario where diesel subsidies become almost zero. I think that's going to be a big positive for oil and gas companies, both downstream and upstream. We already have zero petrol subsidies. I think downstream companies, would have almost negligible subsidies, going forward, and even upstream companies will benefit as the overall subsidy burden comes down. So I think those sectors should see very dramatic earnings increase in the next 12 to 24 months. Another sector which looks extremely attractive is public sector banks. We are seeing this huge NPA problem till the last quarter. There was huge restructuring. There was pressure on profitability. A lot of large banks actually reported degrowth in profits. If we were to look at the last four to 6 quarters, and if you look at from that low base, as the economy revives, as some of the assets become productive and they come back into the servicing category, we're going to see a huge increase in public sector banks' earnings. So that is again one sector which is going to lead the revival of earnings cycle in the short term. Then if you look at some of the infrastructure sectors, which is, I think the recovery there is still 2 to 4 quarters away. But once that road, ports, airports, power space kinds of the bottlenecks get removed. So for instance, if coal mines get environmental clearances, if we get financial closure for some of the road projects, the earnings there will also catch up. So those sectors will also look good. I think the cement companies should also see good earnings growth.
At Karvy, what are your sectoral overweights and underweights?
So our big sectoral overweight is an oil and gas space. Then we also like select infrastructure, public sector banks, and even private sector banks, and cement companies. What we would be underweight at this point of time is the FMCG space. We believe the valuations are extremely expensive there, and the earnings growth are quite muted, and we probably take 2 to 4 quarters for the earnings to really get back. And then I think some of the defensive names in the IT and pharma would also likely to underperform in the next 2 to 3 quarters.
Varun, in terms of portfolio construction, what are some of the top stocks which you are recommending your clients to be must in the portfolio to play this theme of a longer term, both from the large and the mid cap space?
Well, I think broadly, if you look at it, the mid caps are significantly undervalued in terms of their valuations compared to the large cap space. So the upside potential there is far higher. We would believe that a lot of private and public sector mid cap banks, housing finance companies, mid cap cement companies, then select infrastructure names should do well. Because of compliance reasons, I would not be able to go into stock specific, but I think broadly these are the themes.
And Varun, lastly, this is a pretty rosy scenario which we are talking about here, Sensex heading to 1 lakh by 2020. But in the mid, from here in 2020, there could be some big risks or challenges which the equities as an asset class would surely face. Tell us what kind of challenges could investors should brace themselves for?
Well, I think if you go back, the biggest example of what has happened in history is that when President Reagan came to power in 1981, US was also going through a similar scenario of very high inflation, very low growth. In fact, they had 70s, which was almost a stagflationary environment. And then we had Mr. Paul Volcker, the Federal Reserve Governor, which came in and broke the back of inflation. And then, high growth sustained for a very, very long period of time. So I think the biggest challenge to my, understanding is that inflation has to sustainably come down the only way you can build a sustainable macroeconomic recovery, when you can have a sustainable bull run in equity, is then when inflation is convincingly defeated. And I think in Governor Rajan, we have somebody who remains very, very alive and vigilant to the fact that Indian economy tends to overheat, and therefore he is targeting CPI as inflation metric. So I believe as long as we can tame inflation, we can build a huge a base for a big macroeconomic recovery to play out. The other critical factor is that the investment cycle really has to start. It is important that a lot of structural bottlenecks for the infrastructure space, which limit the productivity of the Indian corporate sector, which limit the productivity of various industries, those constraints have to be taken away, and we have to spend our time and energy and resources in building infrastructure. So these two, in my view, are the biggest challenges.
All right, Varun, we'll leave it at that. Many thanks for taking time out for us then this evening.
Right, let's talk about more opinion coming in.